Hello, everyone, and welcome to our Broking Breakfast seminar. For those of you who don't know me, my name is Paul Goldwyn. I'm a partner in the Financial Services Division at PKF Littlejohn, and I am Head of Insurance Intermediaries. We've got a great lineup for you today on our webinar, and our speakers will be focusing on issues which we feel you should be considering in preparing for the future. Our first speaker, and making his Broking Breakfast debut on the webinar scene, is Alex Kirasho-Taban, a senior manager in our Financial Services Division, who also specializes primarily in insurance intermediaries. With the changes to FRS 102 now only a few months away, we have been concentrating recently on the upcoming changes, and that you may recall in earlier seminars and webinars, we have focused primarily on revenue recognition. Today, Alex will be looking at the changes to leases and the alignment of FRS 102 with IFRS 16, and in particular, the benefits of early adoption of these rules, given the positive EBITDA effect for insurance intermediaries. Next up, we have Liam Condron. Liam is a director in our tax department, specializing in human capital, which involves employment taxes, global mobility, etc. Liam will discuss the employment tax considerations when buying or selling your business, and will also share some ideas to help you ensure that you are ready when your transaction kicks off. Last but not least, we have Phil Broadbury, who is a partner in our practice and heads up our technology offering at PKF. Phil will discuss the fast evolving landscape of AI in insurance broking, highlighting governance frameworks, regulatory expectations, and the emerging cyber risks arising from AI. And I understand that Phil will also be providing a few examples. In addition to the speakers today, we also have a selection of financial services and tax partners and directors in our practice who are all insurance specialists in their own right. Before we start our formal presentation, I just want to mention a few other points. Although we're not going to be covering this today specifically in our webinar, wind down planning continues to be a topic that is front and center of the FCA's agenda. And if you don't already have a wind down in place, this is something which we feel you need to seriously be considering. We have printed various articles and have published various articles on wind down planning, written by our in-house specialist Chris Stout, and these attempt to dispel the myths around wind down planning. And please do contact us if you have any queries in this area. So as I said, we're going to be kicking off our webinar today talking about the FRS 102 changes. And in case you haven't seen them, we have already published a lot of online content on the subject, including a revenue recognition guide, a very detailed profit commission article on the potential effect of early recognition of profit commission under FRS 102, and more recently, an article on the changes to leases and the alignment of FRS 102 to IFRS 16. Do please let us know if you have any queries or need any assistance on any of these areas. We are still offering a 1-hour free consultation to all our clients and contacts on FRS 102. So on that note, and without any further ado, I will pass you over to Alex, who will kick off the webinar with the FRS 102 update and changes to leases.
Thank you, Paul, for that candid introduction. I am Alex Kiracho, the Senior Audit Manager within the Financial Services Division of PKF, servicing mostly insurance intermediaries like yourselves. Today's session, like Paul has mentioned, will focus on the new lease accounting rules under FRS 102 that are effective 1 January 2026. I will highlight key concepts, talk about how leases will be measured under the revised standard, the transition provisions, and most importantly, the impact on your financial reporting going forward. and how we at PKF can support you through this change. As I go through these slides, I will highlight the key items on each slide that I believe are most relevant and potentially challenging for insurance intermediaries and brokers like yourselves. So what has changed? The old concepts of operating leases and finance leases are now part of the history books. And this has been replaced by a single lease accounting model. There is no more off-balance sheet accounting. So all leases will now be brought to the balance sheet. Most lessees will now recognize a right of use asset and a corresponding lease liability on the balance sheet. On the P&L, the lease expense will be split between the depreciation charge and interest expense. As you expect, and also as you'd expect, FRS 102 provides optional exemptions. For short-term leases, these are leases that are 12 months or less, and also leases of low-value assets like phones, laptops, and low-value furniture and fittings. For both these types of leases, the short-term leases and low-value assets, the lease expenses are recognized in the P&L on a short-term basis, on a straight line basis. Before applying lease accounting, you must determine if a lease exists. There are 3 questions to consider. Is there an identified asset? Does the customer obtain substantially all economic benefits throughout the lease term when they're using this asset? And does the customer direct the use of this asset? If the answer is yes to all the 3 questions, the contract contains a lease. And for most of you, therefore, your rental contracts will fall under lease accounting. Unless, of course, you have a WeWork arrangement, which again, you might have to look at and consider in greater detail. But also it's important to note that it's possible for a contract to contain more than one lease. It's also possible for a contract to contain lease components and non-lease components. And in all these instances, the accounting for the lease component should be accounted for under the new lease accounting rules, and the non-lease component should be accounted for depending on the nature of what the non-lease component is. However, FRS 102 provides a practical expedient that allows you to account for lease and non-lease components as a single component by class of asset. Once you've identified a lease that exists within your contract, you have to account for it. The initial counting, as mentioned earlier, involves recognition of a right of use asset and a corresponding lease liability. Let's now unpack what these concepts are. The lease liability is your present value of your future lease payments, which includes your rent or parking fees and your utilities, and if all these are included within your contract. Your right of use asset is your lease liability plus your initial direct costs like legal fees if you've engaged a solicitor to draft the rental contract, your dilapidation for provisions, and if you've received any discounts, you need to reduce this against the right of use asset. You will therefore agree with me that the lease liability is the more complex of the two to measure. How do we measure the lease liability? To measure it, you need 3 things. You need the lease term, you need the future lease payments, and an appropriate discount rate. The lease term is the non-cancelable period, plus any periods covered by extension options you are reasonably certain to exercise. The lease payments are your usual fixed payments, which are your regular rental payments you make to the landlord or the lessor. The payments could also be inflation linked. That means there could be variable payments. The other payments to consider are the exercise price of purchase options at the end of the lease, if you are likely to exercise that purchase. The other payments could be your termination penalties or any other residual guarantees. FRS 102, unlike IFRS 16, offers three discount rate options. The first one is the rate implicit in the lease, and this you can only apply if it is readily available. However, in normal circumstances, this is rarely available. The second rate is your incremental borrowing rate. Again, this is complex to determine. So again, very rare it will be difficult for most of you to determine this rate. And the third rate is the obtainable borrowing rate. This is the rate at which the bank will borrow you funds equal to the total undiscounted future lease payments over a term similar to the lease term. This is easy to get, and we expect most of you to use this discount rate when you're measuring your leases. After initial recognition of your right of use asset and your lease liability, subsequently, how do we measure these items? The lease liability is measured at amortized cost. So your lease payments reduce on your reduce on the liability. Your interest expense slightly increases it due to the unwinding of the discount. The right of use asset is depreciated over the lease term and tested for impairment if indicators do arise. It is also important to note that if your right of use asset is classified as investment property, for instance, if you sublease, in instances of a sublease, for instance, then it can be measured at fair value through profit and loss. And if the right of use asset belongs to an asset class where you use a revaluation model, the right of use asset can also be treated in the same way. For the majority of us, we would like to know how this will impact financial reporting going forward. So if you look at the graph there, you will notice that the right of use asset reduces faster than the lease liability. And the lease expenses are front-loaded. What this means, therefore, is there's higher depreciation and interest cost in the earlier years. The impact on financial metrics is far-reaching, and we're going to talk about this in greater detail. EBITDA, if you look at the slide there, your EBITDA will increase, your total assets and liabilities will increase, gearing ratio will go up, earnings per share will reduce, net assets will reduce, your interest cover will reduce, and your right of assets will reduce. EBITDA will increase due to the lease payments that now fall below the EBITDA line in form of depreciation charge and interest expense. Previously, lease payments were part of operating expenses. A higher EBITDA means improved performance for most of you who look at EBITDA as a key performance indicator. It also means higher valuations for your business that are valued at a multiple of EBITDA, creating an appearance of increased profitability. What therefore this calls for is transparency to maintain trust with your stakeholders despite unchanged cash flows. Adopting FRS 102 changes increases your gearing ratio due to the inclusion of the lease liability as debt on the balance sheet. In our example, if you noticed, the gearing ratio increased from 0% to 120%, indicating higher leverage. This will negatively impact your covenant compliance and increase your borrowing costs. You therefore must reassess your capital structure and engage proactively with lenders. Interest cover will reduce due to the inclusion of interest expense. This also may negatively impact your loan covenants. Reviewing loan covenants early and revisiting those loan agreements with lenders is very critical at this stage. Incorporating these changes as well into your financial planning is important to ensure you maintain liquidity. Return on assets will decrease due to increase in total assets from recognition of the right of use asset. A lower return on assets may create negative perception among investors, indicating lower profitability, which in this sense is probably not. So therefore, engage early with stakeholders to maintain confidence and ensure there's strategic alignment. And lastly, your current ratio will decrease due to inclusion of lease liabilities. This may impact the liquidity perception of the business. And therefore recommend that you review early on the impact of your current ratio on working capital to ensure you've got sufficient resources available to meet your obligations as and when they fall due. FRS 102 has adopted a modified retrospective approach as regards the transitional provisions. What this means, therefore, is you don't have to restate your comparatives, but instead apply the new lease from the start of the current period. This approach simplifies implementation and reduces the burden of retrospective adjustments. Also, if you're already part of an IFRS group, you may continue measuring leases under IFRS 16. In summary, therefore, it is very clear that FRS 102 changes on lease accounting is quite significant. It's not a nice to have, it's a must have. And I'm pleased to say at PKF, we have got a dedicated accounting advisory team helping clients navigate these new changes. Thank you all for listening. I now hand over to Liam to take us through employment tax considerations when buying or selling your business.
Thank you, Alex, for your session, and also thank you to Paul for your introduction earlier. My name is Liam Condron, a director here in the human capital team at PKF. That is all things domestic employment tax, global mobility, and payroll. And in this session on this webinar, we'll be tackling some of the key employment tax considerations that you'd need to think through if you are buying or selling a business. Part of my background, I joined PKF around 9 months ago, but have considerable experience in other firms in practice, but also a little bit of time in-house, where I was part of a very acquisitive business. And so I know on both sides of the fence how important these matters can be. So what are employment tax considerations and why would they matter in a diligence process? If one thing is taken away from this webinar today, it's to stress that employment tax matters are not just monthly payroll operation. That is usually the nuts and bolts of a business's payroll, a business's employment tax process. But there are much wider considerations that need to be taken account of. These can include benefits and expenses and how they're treated by the business, pay governance and other regulatory employment obligations, things like employment status and how that may differ from normal employees, off-payroll workers, and even directors. Why does this particularly matter? Well, people are the business, and quite often where a transaction may be related to an owner-managed business, this can be very emotive. Maybe the people that are dealing with the transaction have built up that business, and it matters to them dearly, not just the outcome of the transaction, but some of the tax consequences and tax issues that are being reviewed can have personal consequences for them. Of course, other staff may also be incentivized, and that needs to be managed carefully as well in any kind of transaction. And if issues are identified, what does that mean? Well, quite often they're bottom line costs. So issues can give rise to a genuine liability that needs to be tackled from the past, but also may have an impact on go forward viability of the business. So things need to be thought through there. And what factors can make it a particularly high risk area? Well, in my experience, employment tax typically in many businesses has no central ownership. Unlike corporate tax or VAT, where it may be more usual to have a tax manager who specializes in those areas, it's far less frequent to have an employment taxes person on the ground in the business. And so if these issues are managed by human capital, by payroll individuals, finance, legal, HR, sometimes it can cross over and there can be gaps. When that's coupled with intricate and nuanced rules and commonly misunderstood market practice, we do find that issues can arise that have not been addressed before by the business. And I suppose there's also a point here to say employment taxes is sometimes not often thought of as the most glamorous tax, with corporate tax and VAT taking more of the limelight and being seen as a bigger ticket item. And we'll see on the next slide actually that may not always be the case, but where there's a high number of employees, a large number of contractors, or some really significant payments, there can still be large liabilities. Legislation for employment tax has changed significantly over recent years and continues to do so. And it's often an area that an incumbent government will look at to generate further tax revenue. And lastly, another issue why this can be a particularly high risk area is that businesses potentially being purchased may have undertaken significant growth in recent years or even in distress. And both of those characteristics can give rise to a higher level of risk. A very quick look at how employment tax matters might be reviewed by HMRC. So much like any other tax, they would form part of SAO certification process, CTO rules, and if you were to be undertaken by a business risk review by HMRC, that would also encapture employment tax matters. And if liabilities are found to exist as part of a transaction, what protections might be sought? And these are very similar to things you would see for any other tax: warranties, indemnities, price chip. And the thing I want to pull out here is that HMRC typically have the ability to go back and identify and recover pay as you earn and other employment tax liabilities for up to 6 years. So if one issue is identified in a standalone year for M&A purposes, it may then be extrapolated back. And finally on this page, just something that is often quite a surprise to many people. When we think about M&A, and I mentioned employment tax may not be the most glamorous or forefront tax that forms part of that diligence process. Actually, when you look at the current receipts for HMRC, income tax and NICs form a very, very significant part of the total tax take. And it goes to show that where errors might arise or compliance issues are found, those consequences can be quite significant. So on this next slide, we probably won't run through all of these in great detail, given this is only a short webinar, but the boxes on screen do give a flavour for some of the things that someone like myself, as part of a due diligence process, would be looking at from an employment tax perspective. And just running through the headings here, does the business operate just purely on the UK, or does it have an international footprint? Are people travelling to or from the UK? Has the business got a plan and a governance procedure to account for any UK taxes that may be arising on those individuals? There have also been complex rule changes in that particular area that started in April 2025, which may have led to significant planning on the part of the business to support individuals' personal tax positions. Those things need to be thought through. Benefits and expenses. Often one of the areas that businesses may find they have more of a handle on, and so it's some of the more intricate rules that may cause more of a problem here. And a specific one that we've highlighted are directors' loans accounts. An area that we've found quite commonly causing issues more recently are the fact that directors may have overdue loan accounts, are charging interest, but not actually paying that interest. And the belief that that turns off any benefit in kind reporting charge is one that is not agreed with by HMRC. And so coming back to the emotive issue of employment taxes, the people you may be dealing with in a transaction may well be the people who have these loan accounts that need to be considered. The impact being that historic reporting may need to be undertaken and liabilities provided to HMRC. One of the largest areas, and the next piece on the slide, off payroll arrangements. This is a very common use of labour in the insurance industry, and it's one which can create quite a few headaches, not just in the diligence process, but more generally for businesses. And why is this? There's been significant legislation changes in prior years. Many people will remember changes in April 21, and there was a big rush to implement new processes in each business to manage obligations that shifted the onus of employment status assessments from individuals and personal service companies to the end users. Over time, we've seen that processes have slipped and less focus is being put on this by businesses, but that's certainly not the case for HMRC, who continue to ask lots of questions and open lots of audits in this area. Umbrella legislation is due to come in from 2026. And again, these are changes that shift the onus for pay-as-you-earn liability from an unrelated umbrella company to perhaps the end user who is engaging with these sorts of intermediaries for the supply of labour. What this means going forward is where perhaps there was comfort that no pay-as-you-earn liabilities would arise in instances where individuals were engaged in this way, now there is a potential risk that liability could shift to the end user or the target in a M&A situation. And so that one in particular would be creating questions of how does this impact the business model? What do we need to look at? Are there any historic liabilities that we might want to think about? And lastly on here, obligations in this area can differ on the end user depending on whether they're small or medium and large from a CT perspective. And actually, those obligations might change from the target as a standalone business to what it looks like when it joins a larger group. And so again, this is not just a piece on has the business properly undergone its diligence in and compliance activities in the past, but going forward, will it look different and will the business model suffice going forward? Equity arrangements, we could probably do an entire session on this in its own right. But one area that is always coming up in diligence exercises are the consequences of perhaps share awards or share options creating a pay-as-you-earn obligation on day one or day zero of a transaction, i.e. when that sale takes place, the underlying assets become readily convertible assets and a pay-as-you-earn obligation arises on that sale. There are often employer national insurance costs associated to that, and it's important to understand from both sides whether the employer or the purchaser or the seller, is going to pick up those costs. On the bottom row, pay governance, there's actually a really big piece of legislation coming into force from 27-28 around that time in the Employment Rights Bill, which will give more rights to employees around statutory pay, rights to dismissal, etc. That's one to look out for in the future. And it goes to show that it's not just a tax consequence that you need to be thinking about from an employee perspective in any diligence process, but also the employment law side. Construction industry scheme, perhaps a strange one to include in here for the broking and insurance industry. However, often that is the sort of business where we might find issues arising. And the reason for that is the construction industry scheme is one where any business or any entity that undertakes some form of construction, even if it's not the main business of that entity, can be captured. And so typically businesses who operate in the construction industry might be more ready and more aware of this than others. So one just to be mindful of there. Payments to directors, something that is topical for due diligence, but also just generally from HMRC compliance activity. The concept of an office holder brings people like directors into the scope of pay-as-you-earn withholding in the same way that it would be for employees. And so payments should not be being paid gross outside of payroll. Rather, they should be subject to usual pay-as-you-earn deductions. And quite commonly, we find directors may have been paid outside of this framework for some time and can give rise to fairly significant liabilities. Two specific types of directors that we see this applying to are non-UK resident directors and also non-executive directors who might typically invoice for their services. So one to look out for there. And then finally, payroll. And I deliberately left this last because I wanted to showcase the fact that it's not just payroll that we're talking about here, but one specific area of payroll compliance that is sometimes overlooked might be one-off or non-normal payments. And why is this? Well, a payroll operator or an outsourced payroll provider may be absolutely competent with dealing with regular salary processing, but things like terminations, bonuses, advances can have some quite quirky rules and obligations attached to them. And so we often undertake a bit more of a deep dive into those sorts of payments when undertaking a diligence. A quick whistle stop of what we can expect going forward. April 2025, I mentioned on the prior slide, there were some significant changes to the taxation of non-UK domiciled people in the UK, and actually a rejig completely of the residence basis of taxation in the UK. This has led to some significant planning on perhaps non-UK people coming to the UK for a period of time, or UK people who have been outside the UK for a number of years returning and benefiting from some tax advantaged rules. So it's one to look for in any diligence process. November 2025, we're all waited on bated breath on what the budget brings. And I wish I had a crystal ball to tell you, but actually some of the things that are being rumoured do involve employment taxes. And one that I want to focus on is salary sacrifice. And I've used the term RAID here. Salary sacrifice has been shut down for most things. There are still some areas where salary sacrifice is an effective tax planning measure, but it looks like the government may be shutting down some of those avenues going forward. And if that is the case, then it will just be a point, if you're a business that perhaps operates some salary sacrifice arrangements, to think about how that looks going forward, and are you going to be compliant with new rules as part of any transaction. I mentioned umbrella legislation, so placing of joint liability on end users for temporary labour. That is going to be a big change, and one we do think that will impact the insurance industry in quite a significant way. And lastly, the mandatory payrolling of benefits regime, which has been pushed back a couple of years now to April 2027, but will force businesses of all industries to change the way that certain benefits are reported at year end and bring it more into real-time reporting. So things to think about going forwards. So to close this session, a couple of things to think about, and this probably expands beyond employment taxes and really can be relevant for all taxes, but things to do and get your house in order if you're looking to sell a business, or things you might expect to look for from an employment tax perspective in a potential business that you're looking to acquire. Are data records in good order, and are they readily available? Clear ownership, we talked at the beginning around employment tax being a particular risk area because it is not one where usually there's one person who has central ownership. So is there a clear documentation of who owns what in the process to ensure compliance? And can that be articulated? And finally, to support that ownership structure, are there sufficiently robust processes and policies in place to demonstrate how the compliance is actually going to happen day to day, week to week, month to month? And if those stakeholders leave the business, is it in good hands to be taken up going forwards? So they're just some housekeeping points that I would suggest all businesses look to put in place well in advance of any transaction. And that brings a close to my session. Thank you for listening. And I'll pass it over to Phil, who's got a very interesting session on AI.
Thanks, Liam, and I look forward to that promised dedicated session on equity arrangements. Hello to you all. I'm Phil Broadberry. I'm responsible for the technology division in PK Littlejohn, and that essentially means IT assurance services, data analytics, and advisory, covering AI governance, cyber operational resilience, and third-party risk. As part of my role in the firm, I'm also the data protection partner, so responsible for data and AI risk, and chair our AI steering group. In today's session, I wanted to start off with the AI landscape and really what AI means. What I use for this is what's considered the gold standard in current regulation, the EU's AI Act, and their definition of a machine-based system that's designed to operate with varying degrees of autonomy. It may adapt after deployment, but importantly, capable of inferring from inputs they receive to generate those outputs and decisions. So this is rather than pre-built rules, logic that we have in routines now or calculations. What you should be considering is long-established machine learning algorithms are likely to be included within the EU Act's AI definition. Now, about 10 years ago, when I spoke about artificial intelligence, the focus there was really on process automation, on big data, machine learning algorithms, and APIs to provide integration. So they were kind of the four big topics we were looking at. And over those 10 years, there's undoubtedly been huge strides that have been made around technological deployment. But 2022 was really a game changer. And that game changer was spearheaded through ChatGPT, providing generative AI services, so natural language, human-like inputs and responses that are conversational, trained on enormous data sets, typically on the web, and made available to consumers, businesses, easily through apps and web interfaces. The fastest adoption rate of any technology we've ever seen. Stats are a little bit unclear, so it's hard to pen it down, but certainly with, if you think about the UK, in terms of usage, ChatGPT is out in front by a country mile. Gemini catching up quickly, particularly with the integration they now have with Google Search and in Android. And of course, Copilot through Office 365 integration. But of course, we shouldn't forget really key important players, Claude, Anthropic, and the ability to deploy and train our own models locally. One stat that I did see from Forbes, the 2025 study, showed 1 in 6 companies in the UK have adopted at least one AI technology. I wonder how many of the other 5 may not realize their staff are using it, especially because same study reported that 79% of adults have used ChatGPT-like services at work. I've got Copilot displayed here purely because that's what we have in approved services at PK Littlejohn, and the examples that I show will be based on that. And examples of use I've seen with clients, including in broking space, drafting emails, suggesting agendas, reviewing and comparing documents, policies. So effectively basic workplace productivity. We then move on to workflows or business process automation, but now we've embedded Gen AI services, enabling decision-making, reasoning, confidence scores to be produced. AI effectively is making that business process automation smarter, faster, and more scalable. put vendors in there because there are huge investments being made by the vendor community, and I think it's really important to keep an eye on your vendors and key vendors in the marketplace to see where those investments are going and see what roadmaps are planned. And then finally, agentic AI, and really is the promised land, which is beginning to take hold now. And the way I tend to think about that is, imagine those workflows broken down into operational chunks, each one with the ability to call on each other to start and process a transaction based on their own confidence scores and their own learning from past interventions or events. So an example might be an agent monitoring your client communications, let's say, for example, an email channel, and identifying a midterm adjustment. Call another agent to confirm the identity of that request, and once confirmed, another to request the price. Perhaps another then to send that quote over, and once that quote comes back, passed on to another to collect payment before pushing through to a administration system. Then, of course, once paid, approved, and posted, to issue a confirmation. So what we have here is a huge number of agents that all interact with one another, have learning capabilities to manage those workflows. Of course, exceptions or low confidence transactions might be pushed out to your team to pick up, or even other agents that can go on and further validate and verify the transaction that was asked. Agentic AI is not an area I've seen many live use cases of yet, but it's certainly coming. So if we move on, we've got a few use cases, and I've touched on some of these already, but the ease of data extraction from documents, comparing policy information or comparing regulatory guidelines to your policies. Researching, so very quick responses for deep research into an insurance area or a target market that you might be looking at. Talked a little bit about our email triage ideas and regulatory requirements. I'll come on to in a very quick example. Campaign design enables very quick campaign content, text, images, and the deployment of those campaigns into your target markets very quickly at a very low cost. So talking about examples, if we move on, I have a couple of screenshots here of examples that actually use my Copilot environment. So if you've not used Copilot, it's essentially much the same as ChatGPT or Claude Gemini in terms of a chat-based interface. At the top right there, you can see Copilot supports GPT-4 and GPT-5. And down the left-hand side, a few of the agents that I've got set up, which is essentially predefined prompts. So if I want to do a document review or perhaps assess a SOC 2 report, I can simply just drop the report into there and get the output that I've requested. But just as an example, and as Paul mentioned, wind down planning in the introduction, I thought I'd take from the FCA the guidance on adequate financial resources and do a quick assessment of that and ask to have a set of steps of what do I need to do in order to comply with the guidelines and create a table. So this is working from the PDF that I've supplied it. And if we move on, we have an output of that table. Here's the steps I need to do. What do I need to know? And being conversational, I can very quickly just ask for more information or additional requests on that topic. But for now, I've asked it to include a paragraph references to give me a clear link to each part of that guidance so I can cross-reference it and do my own checks that I've covered the guidance adequately. So the output that we'll see next is simply adding another column to that table where I can see the paragraph references. So the next stage of this was to create a checklist. So give me a checklist so I can go off and create a plan, create a policy, and put that in place. And I've also asked it to go outside of the FCA guidelines and make any other suggestions, because there might be some other things that I think I'd consider to be relevant for my business to include in my checklist. And then as a final step, just as a consideration, I might then want to ask another question to take my policy that I've created and do a gap analysis. And as part of that gap analysis, include a score of how in line is my policy to the guidance that I've been provided. And this time, I would like a new Excel document. So conversational, being really clear on output, really clear on what data we want to use in our task and the role that we want the engine to perform. So we then moved on to ask the question of the audience around where people are at with AI tools and implementation in their business. Now, time was very short at this point, so we moved on to a hands up poll, but we did get some initial responses on here, and they really reflected the hands up poll we did in the room, in that the vast majority of attendees said that Gen AI was deployed in a chat-based scenario within their organization. Fewer with automated workflows deployed, and a few with vendor-supplied AI. At this stage, no one in the room admitted to agentic AI being deployed within their business. That's perhaps not a complete surprise, because this is an emerging space. So moving on, talking about AI governance, and I truly believe AI governance is a platform for innovation, compliant innovation. There was a question in the room actually about whether we should use the EU AI Act as a basis for our planning now ahead of UK legislation and regulation. My view on that is that the EU AI Act is a very sensible approach, and I would completely advise that would be a very sensible step, because UK legislation is likely to follow that to a certain extent. It is the gold standard in the market at the moment. So what we typically see is a steering group or a committee set up to set standards, to set the tone for the organisation and AI adoption, and define training requirements. So key here is we're looking to maintain compliance. So we might have a defined register of approved services, a classification of those services in terms of risk, and the underlying risk assessments that have been done for those approved services. Then look to define and roll out training. Key in training is building trust, building awareness of what people can and can't do. There's a degree of fear in the market about whether what can be used and what can't be used. So having a really clear tone and a really clear position on what can be used when and by whom. We'd see these steering groups reviewing and approving AI services and actively seeking additional services to be reviewed, as well as obviously seeking feedback and trying to drive continuous improvement in the organization. Developments certainly aren't slowing down, quite the opposite. So at the moment, I see a reasonably short or medium term view on approved services, and an expectation of needing to adapt quickly to changes that come to market. So moving on to risks, and I've shared here some common risks issues around AI deployment and data protection, confidentiality. I think it's no surprise would be top of the list. GDPR rules absolutely apply, and also on data data quality, ensuring that we have good data to process and use. The old adage of garbage in, garbage out absolutely still applies. With third-party risk, it can be much harder now to understand where data is being processed, by whom, what's retained, what's being used for training, etc. So a lot of diligence is needed, a lot of contractual safeguards are needed to ensure that we know where our data is being processed. In training, we typically cover ethics, bias, and fairness, and tailor that to the specific organization. When it comes to output quality, and using chat-based generative AI services, we absolutely treat that as an assistant. It's a tool to help you with your job, and a review of output, checking source materials is absolutely mandatory. Culture obviously needs to be right for widespread adoption. And I think we build a good culture on this by having good governance, by building trust in services, by giving people clear guidelines and safeguards on what they can use and when. So then we did another poll just to the audience in terms of how they see their approach to adopting new AI services, and we were very short on time this time, so this was absolutely a hands up poll. But 16 people got in and got a vote in very quickly. The entire room, without exception, that I noted, had a hands up on AI being transformative force, and you must actively engage with it. Lower number on monitoring vendor developments and implement accordingly. So a little bit more of a sit back, but keep an eye on what our investments from vendors are doing. And none online did the poll on taking a cautious wait and see approach. However, there were a couple of hands up there, and there's nothing wrong with that per se. I think this is a case of a very fast changing market, and some will take the view of not being at the leading edge of that and rather see how things pan out. So in summary, I think an awful lot of the next wave will be focused on business process automation and re-engineering for the inclusion of Gen AI in those business processes, and then the involvement of those into agentic AI. Data quality and culture for me are really key barriers to adoption, but governance, I think, is central as an enabler and an innovation platform. See a lot of businesses do very specific workshops targeted on areas for implementation. That tends to lead more to the integrated AI in business process. So select a area to focus on, workshop that through, deploy, and then review. So trying to really see the value at a stage by stage approach. Vendor investments, as I've already said, are huge. So keeping a close eye on what vendors are doing, I think, is key. But the pace of development is at an insane level right now. So keeping an eye on those, and that is only going to increase. So my next slide is actually on cyber, and what I was really positioning here is my my approach to cyber scorecards when it comes to reporting to those in charge in governance. And I break down scorecards into these three areas. This is dummy data, but it doesn't have to be 9 elements. It could be more or less than that, relevant to your business. But start off with policy and procedures. So I've got some key metrics here on a quarterly basis or monthly basis for breaches and policies that need revising, etc. Then our middle row on people, so the training that we're doing, the simulations that we're running, and then finally on a technical side, which is rather focused on patching and access management. But then simple color codes, what things do we need to focus on? And then typically backed up with a little bit of narrative around what plans are coming. Accreditations for me are important. I think they provide a very healthy annual check on your controls and your procedures. So selecting accreditations that are most relevant for your business is important, and reporting back on when those are coming up for renewal, or indeed when you plan to achieve an accreditation. That brings the end of my session. I think it really falls with me now to thank you for watching. Please reach out to one of our team. We're more than happy to assist. Please also look out for information on our next Broken Breakfast, which is scheduled for early December, shortly after the UK budget. Thanks for your time. Goodbye.